Welcome. I'm Catherine Magana here with Steve Wolf, Rachel Ivanovich, and Greg Carroll, where we're here to provide you insights on the markets and planning and much more. Today is January 15th, 2026. Actually, today's
the first tax deadline of the year.
Oh, there you go.
Wow.
And it's the twins' birthday today. They're 17. So
That's why all that money's leaving my accounts. Estimated tax payments.
That's right.
Oh yeah, I made mine last week, and it hurts every time.
Yeah.
But that's a whole other story. Over the last week, we've seen the markets move not too much on the Dow, NASDAQ, or S&P, but the biggest movement over the last week has been the Russell 2000, which are the small cap stocks. So as of yesterday's close, which yesterday was January 14th, it closed at 6.84%. Up from last week. Last week it closed at 3.77. So besides that, everything else in the markets are still up. We're still in green territory for the stock market, but not too much other movement, once again, besides some of the small cap stocks that we're seeing.
Maybe some of the precious metals too.
Oh yeah, well yeah, those have moved a lot. And so it does look like, I was kind of looking at the schedule, there's a lot of earnings coming up for next week, but we won't mention any names, otherwise we'll get our hands slapped, but that's coming up next week. And then looking at where we're at with interest rates, so on the short term, I usually like to give a little update on that. The 1 year, we're looking at CD rates are actually up slightly from last week. We're at 3.65, so not too much movement. And the Treasuries are still about the same. The 1 year is at 3.55, so not too much change over the last week.
And the mortgage rates are actually staying about where they are. They're down a little bit, which is a good thing because I'm looking at real estate in Greenland.
Yeah, they're teetering everything about 6% right now. And it was interesting. We heard from a mortgage lender this morning, and she was saying she's seeing a lot of movement with new purchases. And so it's interesting to see that.
Well, I think
change.
it's really one of the reasons that this administration wants interest rates to come down is because they want to try to get the real estate market moving. People aren't moving because, when you have if you have a 2% rate or 2.5% rate, it takes a lot more to say I want to sell my house.
Well, I think in the fall, Rachel and I, we were at a conference, this leadership conference, and they did a real estate segment. And they were saying the magic number was 5.7%, and when it reaches that point, that you're going to see potentially
a lot of people putting their homes on the market because they don't love the house, they love the rate, and if they sell their house, what are they going to buy? And then they'll have that huge, higher rate.
And it's a big difference.
I mean,
if you're at a 2% rate and you go to a 5.5, now you can pay some points, get it down a little bit. You probably get it down to a little bit under 5%, but it's still a lot more.
I've been talking to a lot of people, and prices are coming down too because nothing is moving. Yeah. I've got a house, half a block from my house, been sitting there for several months now. Not quite that long yet, but I mean, there's no activity there, and there's a different sign, saying, come on in for the open house every weekend. It's a different person because it's a flipper or whatever. But talked to a client last night. They said, well, in the financial plan, let's knock that value down a little bit. So,
well, that's kind of interesting, though, because when people aren't selling, that means there's fewer houses on the market. And for those people who have to buy or have to sell, you would think that would cause prices to go up.
Yeah.
Well, but
depends on how it's priced, though.
Exactly. I think everybody was priced for perfection, and now people aren't as anxious, especially with the interest rates up there.
Well, plus I think what you said is right. That the price of housing has gone so high that people are just saying, well, even at lower rate, I'm not sure I can afford it. Certainly not at the higher rate.
Right.
So the probability of a rate cut this month is about not having a rate cut is about 95%. So it looks like we are not going to have a rate cut, which is anticipated. Although we'll see what happens the rest of the year. There are talks of another couple rate cuts coming up this year, but not coming up at this next this month. And so kind of looking at what's taken place over this last week, we've had a lot of conversations with clients. Things that have come up are, we actually have a client that is revisited his kind of financial plan. His wife passed away last year. And so we were revisiting kind of overall the plans, the beneficiaries. And one of the things that came up as we're reviewing this is the trust is the beneficiary. So we are working with the estate planning attorney and revisiting going to revisit their trust and beneficiaries because once again they do have some charities that are part of
So
the.
I want to ask you
distribution,
two
the IRAs.
especially, 'cause either taxes or other reasons, financial planning, all three of you. Do you think that it is a good idea to have a trust as the beneficiary, let's say, of your IRAs?
Not normally.
Not normally.
And
Because
why?
because the trust rates accelerate very quickly. They have the same rates as individuals, but you get to $11,000 taxable income for a trust, and you're already. He had named the trust, or well, rather had no beneficiary on his IRA, and therefore the estate was the automatic beneficiary. And I mean, that was a huge tax hit. And so we couldn't pass the income out to the beneficiaries and have them pay at their lower rates. The trust actually had to pay 37%.
There is some clauses you can put in a trust sometimes, right? To
But he
do
didn't
a
have a
see-through,
trust.
but he didn't have a trust.
Didn't have a
yes,
trust. Yeah,
So,
it was a probate estate.
yeah,
So
that's really bad.
It was really bad.
That was, yeah.
But there are times when people perhaps do have put a trust if there's maybe some circumstances where you want the money maybe allocated to the
Correct.
trust and maybe you want the kids to not get it all at once.
But you
and-
definitely want to be working actively with an estate planning attorney so that they can help you plan for the situation
Yeah.
and not end up in the situation that I was in as the personal representative paying
But
too
when the
much in
rules
tax.
changed, when the Secure Act of 2.0 came out, when they
Yeah.
changed being able to stretch that over the beneficiary's life expectancy for non-spouse, that kind of changed the game a
Changed
little bit for
things.
everybody. So that's why if you put your trust or even as contingent, you might want to revisit and say, does this still make sense for me? And that's a conversation we're happy to have. And once again, consult with your estate
I mean, I
planning.
had an appointment yesterday with a prospect, and they hadn't reviewed their trust since their kids were, 3 and 4 years old, and now their children are in their 30s.
Oh, wow.
And so a few things have changed between now and then. I mean, they still have the guardians named for their children.
Oh, wow.
now. Yeah, so definitely a good time for them to review that.
And then another conversation we had recently that we thought we'd share is the idea of Roth contributions and
Everybody wants to have a
I
Roth.
never wants a Roth. So we have some clients that have some high income, and so they don't qualify for the Roth contribution, a regular Roth. So the other options that you have are, could you do a mega Roth or a backdoor Roth? Do you want to share a little bit about that?
Sure. First, I'll share what a Roth IRA is. So there's a traditional IRA and there's Roth IRAs. So a traditional IRA, you get the tax break up front if you meet certain income limits, and if you're married, if you have a spouse or if you have a plan through your employer. So there's a lot of rules that have to, but most simply, a traditional IRA, you get a tax break when you put the money in, and then later when you take the money out, you have to pay taxes on it. The Roth is basically, it also has complicated rules, so you want to make sure it applies to your situation, but the money goes in, you don't get the tax break, grows tax deferred, and then later it comes out tax free. And there are a lot of rules surrounding Roth IRAs, so you want to make sure you're getting informed. The backdoor Roth has to do with if your income is too high to make a contribution to a traditional or Roth IRA, you put the money into a non-deductible traditional IRA, and there are lots of rules surrounding this because if you have other IRA accounts, there's something called the pro rata rule that comes into play, and then basically your whole plan backfires. So you want to make sure that you're asking the right questions. So in the most simplest terms, you don't have any traditional IRA money. You maybe have 401ks, but that doesn't count. Maybe you have inherited IRAs, but that doesn't count. So you don't have any IRA money. You make the first-time contribution to a non-deductible traditional IRA, and then you turn around and you convert it to a Roth account. And so if you do that in the same year and close together, there'll be no taxes owed when you do that. And so a lot of people who don't qualify to make the contribution directly to a Roth, they do this backdoor thing, which it's a loophole and it feels like it shouldn't be allowed, but it's in part of the code. So
And it once again, like you mentioned, there's a lot of rules.
There are a
and
lot of rules.
Fortunately, it does not. I mean, this isn't an opportunity for everybody because a lot of
Correct.
people do have IRAs. The other thing that comes up occasionally are the mega backdoor Roth IRAs. And once again, that is case by case depending on your employer plan if they also allow for this. Do you want to share a little bit about that?
So a mega backdoor Roth, like Catherine just said, has to do with your 401k plan or 403b plan. And so most people know about pre-tax contributions to employer plans. So it's a salary deferral. You can put money away for retirement, or you can do after-tax contributions or Roth contributions. But a lot of people don't know about what we just alluded to, and that's pre-tax, but it's not a Roth account. So it's after-tax contributions. It goes into its own little pool of money, let's just call it. And if your employer has this set up properly, you can actually convert all of that into Roth money. So the rules are very complicated. Just make sure that you're doing your due diligence.
Again, you want to do that in the same year so you don't have any taxable
Correct.
gains during that conversion.
Yes.
So this is coming from an employer plan, is that?
That would be coming from an employer.
Correct.
The Backdoor Roth comes from just your individual accounts, whereas a mega Backdoor Roth has to do with an employer plan.
Now, wouldn't it just be simpler if the government would just say,
You can
know what?
contribute. Here you are."
Contribute to your retirement account, and it'll never be taxed.
Yeah. That would be nice.
That would be brilliant.
But the rules would then have to say you can't take it out for a million different reasons.
Yeah.
Right.
So guess what? That would probably eliminate maybe 80% of the need for Social Security for most people. Some people still need help.
Yeah. Well, it's interesting.
And all of our jobs.
I say that there's rules, and there's rules for the rules, and there's a lot of.
I think one part about the mega backdoor Roth that maybe we didn't cover is the fact that it's mega because the contribution limits are much higher. You're not doing a $8,000
I think it's
IRA.
$80,000
If you're over
if you're
50.
over 50.
Mm-hmm.
Yeah, so it's a big number, and it can make a difference if your plan allows it.
Correct.
At your through your work.
So then this ties into this is a good time to make sure you max out your salary deferrals and making sure everything's set up, as well as I know
Withholding. They announced tax season start date,
Yeah.
January 26th.
Okay.
Ooh,
What does that mean?
That means it's the first day we can e-file returns.
it's exciting for
It's
certain
exciting.
people.
She's all happy.
It's almost as much fun as the first day of baseball.
Yes, yes,
But not quite.
Something.
First day of
Something like
basketball.
that.
How about that?
But it is, but like you were saying, it is a good time to make sure that your salary deferrals are set up properly. And a lot of people change their withholding due to certain circumstances throughout the year. And this is a good time to make sure you review your withholding, to make sure that you have the correct withholding. Maybe you got married, maybe you got divorced, maybe you had a baby, maybe you bought a house and now you have mortgage interest. So it's a good time to adjust the withholding to take those changes into account.
We talk about reviews all the time.
Yes.
All right. And you always say, this is a good time. It's always a good time to review, to be
especially-
honest with you.
So actually, that's not true with the withholding, because if you go the whole year and your withholding is off,
Yeah.
you're going to come and do your taxes and you're going to get a shock.
Yeah, it's hard to adjust it in December.
Well,
Yeah.
before I was so rudely interrupted, what I was going to say is it's important to review your plan.
Yes.
And it's important to review your investments and that type of thing. And if you're not sure of where you're at, you can always give us a call. That's what we do. Yeah. So, that's what I was going to say. I'm sorry.
Okay.
I know you took it in the
I
very
was very
narrow.
excited about taxes.
Just taxes, just withholding. That was very
I was
interlinked.
being very specific.
Yes. I got one other planning topic that I was researching for a client, and these are called ABLE accounts. They're similar to like 529 accounts where you save for education. And why are you smiling so much there, Steve?
No, I'm not. Go ahead.
But these ABLE accounts allow for people with disabilities to save and have money grow tax-free or tax-deferred and come out tax-free as long as you use it for qualified expenses. If you're mentally or physically disabled, there's a lot of expenses that go into that. If depending on your income level and your assets, you get on SSI, your limit for assets, it's like $2,000. Doesn't do much for you. Where these accounts are not included in that, nor are they included for Medicaid purposes. So anybody can contribute to these on behalf of an individual, as long as they are disabled. You had to have a disability recognized before age 26, but this year it's actually bumped up to age 46. So there's a lot more people that could be eligible for these. Different states have, tax deductibility on the contributions.
And there are caps on these accounts annually, correct?
There's a $20,000 cap for 26 that usually goes up like 401ks and 529s and everything else. But if you're working and you're not in a company plan, you can actually contribute a little over another $15,600. So potentially, $35,000 and change that you can put in there to grow for future expenses. And some of these plan limits are, hundreds of thousands of dollars up to $500,000.
So when you say you can put money in, who's the you?
Anybody can put in that $20,000, but I think you have to be employed and not contributing to a retirement plan to do the extra $15,000.
Okay.
So
So
family and
if
friends.
that person who's
Family and friends can do that first 20.
all right, so if that person is disabled and not working, then they're not going to be able to do that last 15,000.
Correct. Yep. But you can, grow these over a number of years. You're helping support a child maybe that's, disabled in some fashion, and that they'll have this pot of money to be able to help other than the payments from Medicare or SSI.
Do you know if a person can have that and also get SSI payments?
Yes, they can. This does not count against it. Unless your account is over $100,000, you will be, SSI will be suspended for a period. Yeah. So you can grow these, but 5 times that. But for SSI, you can't have more than 100,000, which is still, a nice sum of money for other expenses that's not going to be
tax
covered.
deferred.
So
Yes.
so if this person has an SSI, is getting SSI, and they have an account more than 100,000, then what happens?
Well, they would not be able to get SSI anymore.
Exactly.
So this particular account, you have to
I
monitor.
said that like 3
Yeah.
times.
Well, I understand, but what my point is though is that so there still is a limit. That $100,000 is a limit.
For SSI.
Right.
Yep.
Yeah.
Okay.
Not for Medicaid.
Okay.
But you can continually spend the account down for
Yes.
housing expenses
Exactly.
and
Education, housing, transportation. I mean, literally almost anything that you need to do to survive is included in those qualified expenses. So it's pretty liberal. It's not, for like educational expenses for a 529
Tuition.
plan, you're a little more narrow specifically to education. But these, it's quite broad, the
Interesting.
allowable expenses. So
All right.
it's just another little tool that you can use depending on children and especially I think with COVID created a lot of kids with depression and bipolar and other things that it's like a pandemic out there that's still running in our younger generation.
So we didn't talk much about the stock market this week, which is unusual, but I did look at the Fear and Greed Index, the CNN Fear and Greed Index, and we're at 66, which means we're back into the greed category. The market seems to be it's going up, but it seems to be chopping around a little bit.
Yep.
When I say it's going
Swirling.
up,
It's rotating.
Yeah, the numbers are going up, but certainly not. Those big mega tech stocks, which had been going crazy, people have kind of been rotating out of those. Not sure if that'll end up being the correct move to make or not. Well, I guess we'll find that out. But certainly there's a rotation.
Vince would have an opinion on that if he were here. So.
Right. But certainly there's a rotation. Small cap stocks have done very well so far at the beginning of the year, and they have done nothing for years now. And the same thing with value stocks,
Right.
Versus the growth stocks. Value stocks have done very little. And so it's not a surprise, really, when you take money out of, stocks that have just gone crazy on the upside and put them into some that haven't. And that's a normal rotation.
It's been pretty unusual. Some of the stocks, like legacy technology stocks that have languished and we've forgotten about are up 20, 30% year to date. And we're only halfway through the month.
Right.
It's a interesting rotation out there.
Yeah.
Yeah.
Yeah, we'll see what happens. Look, we're in a whole revolution of technology right now. Whether those technology stocks we've talked about are overvalued or not, they might be, for right now. But I still have to believe that over the next 10 years, those companies are going to continue to grow. So we'll see. We'll see what happens. The other thing that we didn't talk about was golf. And just to let you know that Greg and
Bragging
Vince
rights.
and I had a little golf tournament, which we have 3 times a year. And
Just remember, compliance is listening.
I
here,
being the
so
oldest
you
one
need
here-
to be very accurate about your statements.
I, being the oldest of the 3,
We had to give them a lot of strokes.
had to teach these young bucks a lesson. And excuse me, I think I beat you
That's so funny.
on a scratch basis. Am I right?
No. I had to
Yeah,
give you- I
no,
had to give
no,
you
no, no.
strokes.
You
I had to
did
give
not.
You strokes.
You shot an
Did I
80.
give you strokes?
Excuse me. You shot an 86. I shot an 84. You gave me one stroke, which means I still came out one ahead. Thank you very much. And I beat Vince, who's a 3 handicap. So just saying.
All right, you had a good day.
So we'll have another one. You'll get another chance.
We felt sorry for him. He was not feeling well.
I love the excuses you make. Anyway, anything else going on this week? No?
I think that's it.
All right. So we will see you again next week. And remember that, the markets go up and go down, but, keep your head in it no matter what. When you hear all sorts of news that you may not like and, it kind of gets you emotionally, don't let that affect your investing. So until next week, happy investing, everybody.
Thank you.
Thanks.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.